Well, a new book, China's Role in the Post-Crisis World, poses the question, did China cause the credit crisis? Well, joining us on the line is the book's author, Giles Chance, visiting professor at the Guanghua Business School at Peking University. Professor, good morning to you.
Good morning.
I'll pose the question then, did China cause the credit crisis?
No, I don't think China did, although I think that some of the actions that were taken by China to stimulate growth in the 1990s, and particularly after joining WTO, did contribute to one of the important preconditions for the credit crisis. But China did not cause a credit crisis, but I think without China the credit crisis would not have happened at the time in the way that it did.
In what way?
Well, I think if the effects of globalization and China's economic emergence had been better understood and handled differently, then I think that perhaps we could have enjoyed the great economic benefits of globalization led by China without the downside. But I don't think these effects were understood. Mistakes were made by politicians, by central bankers and regulators. And now we find ourselves in the middle of a huge global crisis that's still going on.
Why did those economic powers not understand the, let's say, the emergence of China as an economic power?
Well, good question. I think globalization provided huge new sources of supply and demand and changed the way the world economy worked. And this brought the promise of higher growth without a corresponding increase in inflation. And China's emergence, which was the largest part of globalization, as we now know, brought a flood of everyday products to Western consumers at affordable prices. From the mid and late 1990s through China's accession to WTO and into the millennium, this brought downward pressure on price levels, reducing consumer price inflation and interest rates, and in turn this made debt look cheap. And I think that at the time, these effects were construed by central bankers as a result of their own excellent policies. And indeed, after the dot-com crash of 2000 to 2001, there was the fear of deflation arose in America, and monetary policy was adjusted accordingly, and the world was flooded with liquidity, which in fact was not needed. In fact, we weren't really talking about deflation, I don't think. We were perhaps talking more about disinflation.
Is China going to lead us out of our present crisis?
I think that China's capacity to lead the world economically over the next few years is very limited, because simply the Chinese economy is still very undeveloped. And I think that it's still relatively very small as compared to the rest of the world. I mean, America occupies nearly a quarter of world GDP. China's, something more like a fifth of that. So China's capacity to lead the world, I think, in the short to medium term economically is limited. It is playing at the margin a much greater role than it did before the crisis. And I think its impact on Asia has become much more significant. It's become a major motor for an engine for Japanese and Indian and Asian growth. Trade between China and other Asian countries has ballooned over the last 5 or 10 years, become a major trading partner. So it's got a very important economic impact on Asia, and I think that we're seeing that right now as Asia starts to surge forwards and we start to get a significant decoupling effect, the decoupling effect which much talked about for years, but we're at last beginning to see that. But I think the capacity to lead the world over the next few years economically from China is limited simply because it's still a poor and undeveloped country.
And much talk as well, apart from decoupling, a lot of talk about the Chinese yuan. We heard there from Sandeep Bhandari from Standard Chartered Bank there talking about allowing the yuan to appreciate. Do you think that is going to come about? He says not until 2011.
Well, I don't agree with that. I think that the Chinese authorities have proved themselves to be highly capable people. People like, for example, Yi Gang, Deputy Governor of the People's Bank of China, who's a tenured professor at Indiana University in economics, and people like that. I mean, they know a lot of things, and they're very experienced, and they are involved closely with the IMF, the World Bank, and other leading economists. They know what's going on, and I think that a lot of them feel that their economic model does need to change. They need to create a strong domestic demand to support their growth. And in this context, the important word for China is productivity, because China faces a major demographic problem over the next few years. From next year, the labor force stops growing. A few years later, their population will start to shrink. and the Chinese working population will have to support a larger and larger number of young and retired people. They need to become much more productive. Each unit of Chinese input must start to generate a greater return, both in terms of labor and capital, and environmental considerations make this doubly important. So the Chinese policy of subsidizing their industry by an undervalued exchange rate or by other means has to end and has to give way to a more efficient economic strategy which generates higher economic returns. And I think that allowing the Chinese currency to rise is an important part of the strategy of increasing productive and economic efficiency. The longer they suppress their currency, the more severe the distortion is going to be.
Okay, well, thank you very much indeed for joining us this morning on the programme. Professor Giles Chance, visiting professor at the Guanghua Business School at Peking University. His new book is China's Role in the Post-Crisis World. It poses that question, did China cause the credit crisis? I hope we answered it for you this morning on the programme.